Hey guys, what's up? Thanks for tuning in again and watching Passive Earnings. In this video, I'll show you my take on XDTE versus QDTE. Which one should you be investing, or should I be investing moving forward? And why do I think these are good ETFs to invest in? And then before ending this video, I'll give you good understanding of my current portfolio, where it stands today, and what are my next moves. So if you like this content, please stick around, and let's get right into the video. So starting from Roundhill S&P 500 0 DTE covered call strategy ETF, which is XDTE, it has provided 29 cents per share of dividend every single week, whoever owns one share of this ETF. So if you are investing in XDTE or QDTE, these are income oriented covered call strategy ETFs, meaning they'll provide you good income on weekly basis. Not a lot of ETFs do that on weekly basis. Plus they target Roundhill targets to have minimum downside or NAV erosion, as they call it, for on their assets. But the difference between XDTE and QDTE is that QDTE is based on the Nasdaq 100, whereas XDTE is based on S&P 500 ETF index. Another thing that you probably notice here is that XDTE provides an average of 29 cents dividends every single week, whereas if you look at the QDTE, it has provided over 43 cents per share every single week. So in long term, if you look at the dividends, QDTE seems to be a better option, considering that the price of QDTE is $42.78, whereas if you look at the XDTE price, it is $52.20. So why would anyone want to invest in QDTE over XDTE? Is based on just the volatility. The premium will be higher, so you'll get more dividends. But XDTE is more expensive and provides less in dividends. So why would anyone want to invest in XDTE? The answer lies in the charts here. So if you look at the QDTE chart year to date, since its launch date, it has eroded 7.10% since March, and this is following the QQQ index or Invesco 100 index. QQQ is another ETF based on that index. So that has appreciated in the value since March, but this covered call strategy has depreciated, and a lot, 7.21% it has depreciated. So if you would have invested or bought 100 shares, it would have cost you $46 per share, so $4,600 for 100 shares, and your total currently would have been $4,273. But then again, you got paid a lot in the dividends. If you look at the dividend history of QDTE, and then vice versa for XDTE, if you look at the performance, it's pretty much break even. It's actually in positive after today's returns, so meaning you do not have any NAV erosion happening on your principal amount that you have invested. So if you bought $5,200 worth of 100 shares, you would still have $5,200 plus the 29 cents per week income that you have made. So that's the power of XDTE and covered call strategy on S&P 500. With less volatility, it provides less premium or less dividends, in other words, and also tries to keep the NAV value same. And as asset under management for both of these are growing like crazy. These are one of the very fastest growing ETFs, both. If you look at the records, so XDTE currently stands at 66 million annual asset under management, and QDTE has over $241 million in asset under management. So people are more leaning towards QDTE, but if you look at the bigger picture, XDTE is performed better, considering that it has paid dividends 29 cents per week, plus it has not changed or depreciated your principal amount here. So that's the difference between these two, and for my liking, I would be investing more in XDTE, and my strategy would be investing the premium that I collect from selling covered call and selling cash secured puts on my account, and putting that money in buying XDTE. But first, my target or my goal here is to invest to get 100 shares of SPY. Currently I have 20 shares of SPY, 20.15, and my average cost is 543, which is in line with the current market value, just above 3.3% of what I have invested. Currently in my portfolio, I'm up close to 1%, which is $1,600. But these XDTE and QDTE will supercharge my investments, and I'll be reinvesting part of the distribution that they give, and part of that will be going in buying more aggressive growth oriented ETFs. So that's the strategy that I'll be pulling off. Now going back to my portfolio, which you see here, 165,000, close to $166,000. Today I sold a covered call on QQQ and made a couple bucks. Again, I'm doing this every single day, making a couple bucks here and there and reinvesting those to accumulate more shares of QQQ. Long term, I want to keep these ETFs in my portfolio. I have over 104 shares and portfolio diversity of 41.5%. So I'm keeping my cash that I get selling covered calls on QQQ back in QQQ. So I'm buying more of QQQ. I have 515 shares of SCHD, and on SPY I'm building my portfolio every single day. I'm investing $110 on recurring payments, plus anything that I collect from selling these cash secured puts and covered calls other than QQQ goes also into buying more of SPY. So I'm building or supercharging this with my investment plus the premium that I collect from the market. One last thing that I want to show you, the performance of our selling calls and put premium. So for the transparency, I wanted to show you what I have made till date. So this is the call that I sold today, covered call at 491 strike price. Today is the date and it's expiring today. I collected $2, $1.97 after paying Robinhood their fee that they have to pay forward. So month to date, I have made close to $1,400. I'm super happy with this performance and looking forward to invest more money every single month, and then be able to reap the benefits of cash secured puts and covered calls on the stocks and the ETFs that I love. So that's about it. Thank you guys for watching. I hope you guys will like this video. If you haven't already subscribed, please make sure to do so, and I'll see you guys in my next video. Till then, take care of yourself and people around you. Goodbye.